Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. This is going to be a completely different video from my usual videos. It's going to be very short, very sweet, a very condensed, extremely high value video. I'm only going to show you a handful of charts that people pay thousands and thousands, even tens of thousands of dollars. They pay top dollar to top technicians just to see these kinds of charts. I'm going to start with the daily chart of the S&P 500 and end the video with another critical version of the same S&P 500 chart. I'm going to cut out all of the fluff. Every single minute is going to be very important, so please stick around to the end. So let's start with the daily chart, everybody. This green demand zone is very important. We have it coming up at 353 all the way down to 350 exactly. Why is this demand zone important? Well, let's take a look at this consolidation zone back here in 2020. We had this very clearly defined consolidation zone, and we have three levels that I'm looking at. The first level is right here at the close of this green candle at 358. We took out that level on Friday. I have another level right here, 352.5, and I expect the market to touch this level on Monday. I have another deeper level exactly at 350, and this is where I expect no more selling to come, at least for a couple of weeks. Here's what I want to see Monday, everybody. Here's what I expect to see Monday. I expect a gap down, a sell-off to the downside, hitting that 353 target, and perhaps going deeper to 350, but I doubt that. I think we'll stop at around 353, 352, something like that. And then we rally up, take out the open of the day, move back up, and then move back down, forming a doji candle that looks something like this. This is the best case scenario, everybody. This, in my opinion, will mark a bottom, not the bottom, but a bottom. This by no means, guys, will be the end of the bear market. It's just a bottom, a tradable bottom, just like the many other tradable bottoms that we had, including the June bottom, including the May bottom, and including, everybody, the March bottom. So I'm expecting this kind of bottom. Now let's take a look at the SPX, the S&P 500 chart. I just want to show you two critical things here, everybody. The first is that we have a bullish divergence between the RSI and the price action, where on the price action we made a new low, and on the RSI we actually made a higher low. That's the first observation. The second observation, everybody, is this. This is the 50% retracement level from the low of the pandemic all the way up to the high that we had in January. This is the 50% retracement level, and look at that. It comes out at 3,535. Exactly the same spot where we closed right here, exactly where I expect the stock market to go down to on Monday. So let's say we open here, we go down, boom, maybe take it out, maybe touch it, flirt around, do something, I don't know, and then move back up. Make a doji, something that looks like this. Let's jump into the VIX, everybody. This is the volatility index, the fear index, and what do you know? We have another divergence. The VIX is making lower highs as the S&P 500 is making lower lows. When the S&P 500 sells off, we expect the VIX to move up. What we've been witnessing over the past few days is that the VIX has stopped here and has been steadily coming down, even though the stock market has been selling off. We had the exact same divergence building out here, where we had a bottom. We had this divergence building out here, where we had this bottom. And so, guys, these divergences end up playing to the upside. Now, let's take a look at the HYG, the smart money. Again, another divergence. Look at this, everybody. We've made a higher low on the HYG, the high yield bonds, the smart money, as the S&P 500 has made a new low. The exact same type of divergence was built out here, and then we had the June low. We also had this divergence play out in the May bottom, and even if we go back all the way to October of 2020, we had the same kind of divergence building out, where the S&P made new lows and the HYG was making higher lows. So again, these divergences tend to play to the upside. Now let's take a look at another divergence. This is the percent of stocks above their 200-day moving average, a breadth indicator that looks at how many stocks in the entire stock market are either moving up or moving down above their 200-day moving average. And what do you know? Again, another divergence making higher lows as the S&P is making new lows. The same type of divergence occurred back here in the May bottom as well. We made a new low on the S&P and a higher low on the breadth indicator. And if you squint really hard, you'll find a similar divergence right here if you connect the closing prices. Now let's take a look at the CPC put to call ratio buy and sell signal. And I want to point something very important out. Look at this, guys. We're now trading at the bottom of this support line for this ascending wedge. Now the put to call ratio, everybody, measures how many puts are being bought versus how many calls are being bought. And so puts are bearish and calls are bullish. So when this ratio spikes to the upside, it means that people are being more bearish. They're buying more puts to protect themselves and fewer calls. When this ratio breaks to the downside below 1.1, we have nice rallies. We had that happen back here in June, and we had that happen back here in May, and we had that rally, and then we had that happen again on May 13th, and then we had that rally. Now, it's not a confirmed buy or sell signal until we get a crossover on the PPO. We need to get a crossover on the PPO. And so here we happen to cross down below 1.1. At the same time, we had that crossover. We had that same thing happen here. Here, everybody, we had that crossover below 1.1, but we did not get that crossover on the PPO. And so that did not confirm the bottom. But we did have a bottom here and we did rally. And so we don't have yet a crossover on the PPO, but that could happen as soon as next Tuesday. So if we get a crossover on Tuesday, that will confirm a buy signal for a nice rally to the upside. Now let's take a look at seasonality, everybody. And what do you know? Look at this. This is October. All of these are midterm election years. The red line is the second year, new Democratic president, midterm year. And what do you know? In the beginning of October, we tend to have just one last bit of selling, and then we have a rally. If you look at all of these charts, guys, we tend to rally from the beginning of October into around the last third to the middle of October, somewhere between the middle of October and the last third of October. Now let's take a look at my last chart, the SPX, the S&P 500 weekly chart. And I just wanted to point out two key important things. Well, three things. Number one, we are now sitting at the very top of this 200 weekly moving average. A weekly moving average where we systematically tend to see buying. Look at that. In the 2020 crash, the pandemic low, we overtook it, yes, but we ended up rallying. In 2018, we tagged it and then we rallied. In 2016, we came really close to tagging it and then we rallied. Here, we probably tagged the 200 EMA, exponential moving average. This is the simple moving average. And even if I go back to the 2008 crash, look at this, guys. We took it out. We absolutely took it out. We closed below it. We closed below it again, and then we had a rally. Same thing happened in the 2000 crash. This was 2001. We completely blasted through it, and then we had a rally. This does not mean the bear market is over. It just means we tend to have this rubber band effect where we go tag it, perhaps take it out, and then we rally. This happened systematically for 20 years, even longer than that, including two bear markets. Another signal that I talked about just a few weeks ago when I warned everybody be careful, we're going to have a 10 to 20% sell-off in a matter of weeks. That's when we had this rejection of the 125-day moving average right here, when we had that rejection of the 125-day moving average after already rejecting the 200-day moving average. This rejection, guys, leads to 10 to 20% sell-offs, and so far we've had a 12% sell-off, 13% sell-off, and so the median would be 15%, and that would take us down to 3,500. We also have this 50% retracement level, and we have the 200 weekly moving average. So we have so many supports here, guys. We have so many support levels here. And again, I'm not calling for an end of the bear market. I'm simply pointing out to the odds of a rubber band effect, a counter trend rally, a brief one that lasts 2 to 3 weeks perhaps, and then we get that dump towards the end of October. That's what this seasonality is indicating, and that's what I tend to believe at this point. So we took a look at the 200 weekly moving average, and we took a look at the 50% retracement level, and now I want to show you the sell-offs that occur after that rejection of the 125-day moving average. This was the most recent rejection that we had just in 2018, and it ended up with a 15% sell-off. Prior to that, we had the same kind of rejection in the middle of 2010, and then we had this quick 10.5% sell-off. And prior to that, we had the same kind of rejection right here in the middle of the 2001 bear market, the 2000 to 2003 bear market. And then we had a savage, horrific 22.5% sell-off. So far, since that rejection, we had a near 13% sell-off, and I still expect another dump on Monday. And at that point, everybody, I expect all of the bullish divergences that I talked about in this video to play out to the upside, at least into the middle of October, and then get that one more dump towards the end of October, taking out this low and bringing us deeper and deeper into this consolidation zone. We could go to 3,200, we could stop at 3,300, we could stop at 3,400. It's anybody's guess at that point. But if seasonality plays out as expected, we should take out this low that we're making now, and that would be the low for the year, where we rally to the upside in November and December for that nice holiday rally. So right now, everybody, I expect a bottom next week, a bear market rally, a nice counter trend rally, another top, another sell-off, another bottom, the bottom for the year, a rally to the upside, and then for next year for the bear market to resume with more selling in Q1. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.